The most dangerous changes in a financial system usually do not arrive with a crash. They arrive as a benefit, they arrive as a new account. They arrive as a promise to help ordinary people. They arrive with language that sounds compassionate, modern, and fair. They say more access, lower fees, more portability, free money, a better way to retire. Most people hear that and stop thinking. They focus on the benefit and miss the system being built underneath it. That is why the new Trump IRA matters. It is not only a retirement account, it is a signal. It tells us how the American retirement system may be changing, how more money may be pushed into the stock market, how the government may try to solve inequality with financial access, and how the cost of that solution may appear later through more debt, more money creation, and more inflation. When I look at this, I do not see only politics. I see a machine. The existing machine is the 401k system. It works well for some people, especially higher income employees at companies with good retirement benefits and employer matches. But it does not work equally for everyone. Millions of workers do not have access to a 401k at all. Gig workers, low-income workers, part-time workers, small business employees, and people moving between jobs can be left outside the system. That is the problem the Trump IRA is trying to address. But every solution has side effects. That is the first principle. A financial policy should never be judged only by what it promises. It must be judged by how it is funded, who benefits first, who pays later, and what behavior it creates. The 401k has real limitations. The first is access. A 401k is tied to employment. If your employer offers a plan, you may be able to contribute. If your employer does not offer a plan, you may be locked out. This creates a retirement divide. The people who most need help building assets may be the least likely to receive structured access, matching contributions, and institutional retirement support. A high-income employee at a large company may get a 401k investment menu, payroll deductions, and an employer match. A lower-income worker driving for an app, working hourly jobs, or moving between unstable employers may get none of that. That is not a small difference. It is a compounding difference. If one worker gets decades of automatic investing and matching money, and another worker gets no structure at all, the wealth gap widens not only because of income, but because of access to the compounding machine. That is the second principle. Access to the compounding machine determines who gets to use time as an ally. The second problem is fees. Many 401k plans contain funds with expense ratios that are higher than they need to be. Not every 401k is bad. Some plans are excellent, some offer very low-cost index funds. But the average plan can still carry meaningful fees, and those fees compound against the worker. A fee looks small in 1 year. 1% does not feel like much. 1.25% may not feel dramatic, but over 30 years, recurring fees can take a large share of the ending balance. The source gives a simple example. If a person invests $500 a month for 30 years and earns 8% before fees, the account could grow to roughly $679,000. But if the average 401k fee is about 1.26%, the ending balance falls to roughly $540,000. The difference, about $139,000, goes to fees. That is real money. It is not just a line item. It is future retirement income that never reaches the worker. If the fee is capped at 0.15% as described for the Trump IRA, the ending balance in the same example is much closer to $660,000, and total fees may be closer to $19,000 rather than $139,000. That is a very different outcome. This is the third principle in retirement investing. Fees are not small if they repeat for decades. A high fee is like a slow leak in the retirement bucket. The worker may still accumulate money, but the compounding that should have belonged to the worker is partially transferred to the financial industry. Low fees matter because they allow more of the return to remain inside the account where it can continue compounding. But fees are only one part of the system. The third problem with the 401k is portability. A 401k is tied to an employer if you change jobs. The old account may remain behind. You may need to roll it over. You may forget about it. You may leave money in old plans with bad options or high fees. You may cash it out because the process feels confusing. You may become reluctant to leave a job because the retirement structure feels difficult to move. A retirement account should not make a worker feel trapped. In a modern economy where people change jobs often, work independently, freelance, drive, consult, build side businesses, or move between employers, the retirement system should be portable. The Trump IRA is described as portable because it is not tied to one employer. It is linked to the worker. If you are working in the United States and qualify, the account stays with you. That is a meaningful design difference. That is the fourth principle. A retirement system tied too tightly to one employer becomes fragile in a mobile labor market. Now, the Trump IRA is presented as a way to solve these problems: more access, lower fees, portability, low minimums, government match for lower income workers. This sounds attractive, and in certain ways, it is attractive. If a worker has number 401k, no employer match, no easy payroll investment structure, and no habit of investing, a low-fee account with even small contributions can be powerful. If someone can start with $5, the psychological barrier falls. If the government matches 50% up to $1,000 for qualifying workers, the incentive becomes stronger. A 50% match is enormous. If a low-income worker contributes $2,000 and receives $1,000 from the government, that is an immediate 50% return before market returns. That kind of match can change behavior. It can make investing feel possible. It can bring people into the ownership economy who were previously outside it. This is the fifth principle. A match can turn retirement saving from a sacrifice into an opportunity. But the match is also where the deeper system begins. There is no such thing as free money at the national level. There is only money paid now, paid later, paid through taxes, paid through debt, or paid through inflation. The source says the government may offer up to $1,000 per year, not as a one-time contribution, but as a potential recurring annual contribution for qualifying workers. To receive the full amount, a single filer would need income below $20,500 and contribute at least $2,000. Married filers would need income below $41,000 for the full benefit. The benefit phases out above those levels and disappears at higher incomes. This is targeted support, but if millions of workers qualify, the total cost becomes large. That cost must be funded. The United States government already spends more than it collects. The source uses a rough 2026 picture, around $5 trillion of tax revenue and about $7 trillion of spending, leaving a deficit of roughly $2 trillion. Whether the exact numbers move, the basic structure is clear. The federal government is already running large deficits. If a new program adds spending and taxes are not raised, the deficit increases. If the deficit increases, the government must borrow more. If the government borrows more than private investors in foreign countries are willing to absorb at acceptable rates, the Federal Reserve may become more important in financing the system. And if money is created to support government borrowing, the cost can appear as inflation. That is the sixth principle. Free money from the government is not free to the monetary system. It shifts the cost into another channel. This is why I always ask who pays. If the worker receives a match, that is a real benefit to the worker. But if the government funds the match with debt, the liability moves to taxpayers, bondholders, currency holders, and future generations. If the money is ultimately monetized, the cost may appear through a weaker dollar and higher prices. The individual sees a $1,000 match. The system absorbs a larger deficit. Both can be true. This is how modern fiscal systems work. They give visible benefits and hide costs inside larger balance sheets. That is the seventh principle. The benefit is visible. The funding mechanism is often invisible, but the invisible mechanism can be more important than the visible benefit. Now, let us think about the stock market effect. If the Trump IRA begins in 2027 as described, it could bring new money into the stock market. The source estimates somewhere between $32 billion and $68 billion of new money entering U.S. equities. This would come from worker contributions and government matching contributions. In market terms, that is a flow, and flows matter. The stock market is priced by supply and demand. When more buyers enter than sellers, prices tend to rise. When more sellers enter than buyers, prices tend to fall. This is not the only force in markets, but it is a major force. Earnings matter, interest rates matter, valuations matter, liquidity matters. But flows matter too. If millions of new accounts are created and automatically direct money into broad index funds, that creates persistent buying pressure. This is not new in concept. The 401k system itself helped create long-term stock market flows. Automatic payroll contributions pushed money into mutual funds and index funds month after month. IRAs added another channel. Free brokerage apps added another wave of individual access. Now the Trump IRA could add another flow, especially from workers who previously had no employer retirement plan. That is the eighth principle. Retirement systems are not only savings vehicles. They are stock market flow machines. Once money is automatically directed into the market every paycheck or every month, it changes demand. It creates a systematic bid for financial assets. It may support valuations. It may increase participation. It may help workers build wealth. It may also make markets more sensitive to policy-driven liquidity. This is where the opportunity appears. If more money is being directed into the stock market, investors should understand where the money is going. Broad market funds, total market funds, SP 500 funds, low-cost index funds, large-cap companies, possibly the same vehicles that dominate retirement allocations. This does not mean the market only goes up. It does not mean crashes disappear. It does not mean recessions disappear. In fact, more retail participation and more policy-driven flows can sometimes increase volatility. When money enters quickly, prices can rise quickly when fear appears. People may also sell quickly. Free money can create bigger swings, not smaller ones. That is the ninth principle. More money entering a market can raise prices, but it can also raise volatility. People must understand both sides. If the market is supported by new flows, asset owners benefit. If the funding creates inflation, people relying only on wages and cash may be hurt. This is the central paradox. A program designed to help lower-income workers invest may also contribute to inflation if funded through more debt and money creation. Inflation can make everyday life more expensive, but the money directed into the market can raise asset prices, benefiting investors. So the same system can hurt non-owners and help owners. That is why the message cannot simply be, this is good or this is bad. The message is understand the mechanism so you can position yourself intelligently. That is the 10th principle. Inflation punishes cash, only people, and rewards people who own scarce or productive assets. If the system creates more dollars, then the question becomes whether you hold only dollars or whether you own assets that can rise as dollars lose value. Stocks are one such asset, real estate can be another, gold and silver can be another, businesses can be another. But the Trump IRA specifically directs attention toward the stock market. That means ordinary workers may be encouraged to become owners of businesses through index funds. That is positive if done intelligently. But it is also part of the larger financialization of retirement. More retirement security becomes tied to market performance. More people become dependent on stock prices. More political pressure may emerge to support asset markets. That is the 11th principle. When retirement becomes tied to the stock market becomes more politically important. This is already true with the 401k system. If millions of workers have retirement accounts invested in stocks, then a stock market crash is not only a Wall Street problem, it becomes a household problem. It affects retirement confidence, consumer behavior, politics, and public mood. A Trump IRA expands that logic. If more lower-income workers are brought into the market, the political stakes of asset prices increase further. This can create pressure for policymakers to keep markets supported. Not always directly, not always openly, but through liquidity, fiscal support, lower rates, emergency programs, and market-friendly policy when stress appears. This is why investors must watch not only earnings but policy. Markets and policy are increasingly linked. Now, let us be careful about the account itself. A Trump IRA, as described in the source, is not a replacement for every 401k. It is a new account aimed at solving access fee, portability, and minimum contribution issues. If you already have a strong 401k with a good employer match and low-cost funds, you may still benefit from that plan. Employer match is powerful. Tax treatment matters. Contribution limits matter. Account rules matter. The correct answer is not to blindly abandon one account for another. The correct answer is to compare what is the match, what are the fees, what are the investment options, what are the tax advantages, what are the contribution limits, what are the withdrawal rules, what is your income level, do you qualify for the government match, do you already have access to a good retirement plan? That is the 12th principle. A new retirement account is not automatically better for everyone. It is better only if it improves the actual system for the person using it. This matters because financial products are often sold with broad slogans. But households have different situations. A worker with number 401k and low income may benefit greatly. A high income worker with a strong employer plan may not qualify for the match and may have different priorities. A gig worker may value portability. A worker with very low cash flow may value the $5 starting minimum. Context determines value. Now fees again, the Trump IRA's fee cap of 0.15% is important because it forces a low-cost structure. But low fees are valuable only if investment quality is comparable. A fund with low fees and poor design is not automatically good. A fund with higher fees and superior strategy might be worth it in certain cases. Though many high-fee funds fail to justify their cost. The point is not that all fees are bad. The point is that every fee must earn its place. That is the 13th principle. Fees are acceptable only when they buy value greater than their cost. Most investors should start by looking for broad, low-cost, diversified exposure. That often means index funds or ETFs. If a retirement plan offers expensive funds that do little more than track the market, the worker is paying too much. The homework is simple. Look at the expense ratio. If the fund charges 1.26%, ask what you are receiving for that fee. If a comparable index fund charges 0.15% or less, the high-fee fund must justify the difference. Over decades, this question can be worth six figures. Now, portability deserves more attention. When workers leave jobs, retirement accounts can become scattered. One small account at an old employer, another at a second employer, a forgotten plan, an old login, high fees, poor options, confusion. This friction hurts people. A portable IRA-like structure can reduce this friction. If the account follows the worker, contributions can continue regardless of employer. That is especially important in a labor market where fewer people spend an entire career at one company. The retirement system must adapt to the way people actually work. That is the 14th principle. A mobile workforce needs mobile retirement capital. If retirement accounts remain trapped inside employer structures, many workers will undersave, lose track of accounts, or fail to invest consistently. Portability can make compounding easier, and anything that makes compounding easier can have large, long-term effects. Now, let us think about low minimums. Starting with $5 sounds small. Some people may mock it, but small minimums matter psychologically when a person feels excluded because they cannot invest $100 a month. A $5 entry point removes the excuse. It says start now, build the habit, increase later. This can be powerful for lower income workers. The first goal is not to make the first contribution huge. The first goal is to enter the system. Once a person enters the system and sees money invested, they may contribute more over time. The habit can grow. The identity can change. That is the 15th principle. The first investment is often more important for behavior than for dollars. A $5 contribution will not make someone rich, but it can begin the identity of being an investor. And identity matters. People who see themselves as investors make different decisions. They pay more attention to markets. They understand compounding. They care about fees. They begin asking how money works. They become less dependent on wages alone. This is one of the positive aspects of broader retirement access. It can shift people from consumers only into owners. Now, let us discuss the government match for low-income workers. A match can be life-changing if they can afford to contribute enough to receive it. But that phrase matters. If they can afford to contribute, if someone earns below $20,500 per year, contributing $2,000 may be difficult. That is about 10% of income. So the match is generous but not effortless. The worker still has to save. That is good in one sense because it encourages disciplined behavior. But it may also mean that the poorest workers cannot fully capture the benefit because their cash flow is too tight. That is the 16th principle. A match helps only if the worker has enough surplus to earn it. This is an important design issue. A person earning low income may need every dollar for rent, food, transportation, healthcare, and debt. The match may be available on paper but difficult in practice. Still, for those who can contribute, the match is powerful. A 50% match is far higher than ordinary expected market returns. It should be taken seriously. Now, let us think about moral hazard. If the government contributes money directly into stock market accounts, it may encourage asset price dependence. People may become more willing to tolerate deficits because the deficit-funded money appears in their account. Investors may celebrate because markets receive more flow. Politicians may support it because it feels like helping workers. Wall Street may benefit because assets under management rise. But if the funding comes through debt and monetary expansion, the long-term cost may appear through inflation and currency debasement. This is a classic problem. The immediate benefit is concentrated and visible. The long-term cost is diffuse and delayed. That is the 17th principle. Systems become dangerous when the benefit is immediate and the cost is delayed. This is how debt grows. Every new program can be defended by its benefit. But if the funding discipline is absent, the cumulative result is higher debt, higher interest costs, more dependency on central bank support, and lower currency purchasing power over time. No single program causes the entire debt problem, but many programs together create the debt machine. That is why every new spending program must be evaluated in context. The government is not starting from zero. It is starting from large deficits. Now, let us talk about the Federal Reserve. The source frames the Federal Reserve as the lender that can create money and support government borrowing. In practice, the Fed buys and sells assets, controls reserves, sets policy rates, and influences liquidity. When the Fed expands its balance sheet, it can create reserves and support financial conditions. The mechanics are more complex than simply printing cash, but the practical effect in the public mind is money creation. When more money is created without a corresponding increase in real goods and services, the value of each unit can fall. That is inflation. You can print dollars, you cannot print houses. Oil, food, nurses, factories, or productivity by keystroke. That is the 18th principle. Money creation can increase claims on wealth, but it cannot automatically create wealth itself. If more dollars chase the same or limited assets, asset prices can rise. If more dollars chase the same goods and services, consumer prices can rise. If productivity rises at the same time, the system may absorb some of it. But if money grows faster than real output, purchasing power suffers. This is why government spending and inflation are linked. Not always immediately, not always 1-to-1. But structurally, if the government sends money into retirement accounts, that money may raise asset demand. If the funding increases debt and money creation, it may also weaken the dollar over time. This is the dual effect. Asset owners may benefit, currency holders may lose purchasing power. Now let us think like an investor. If more money is going into the stock market, what should you own? The simplest answer is broad market exposure. A total U.S. stock market fund like VTI gives exposure to thousands of companies. An S&P 500 fund like SPY gives exposure to the 500 largest U.S. companies. These are not recommendations to buy blindly. They are examples of how investors can own the asset class receiving flows. If the money flows into broad retirement accounts, it may naturally go into broad index funds. The largest companies may benefit because index funds allocate more capital to large market cap companies. This can reinforce the dominance of large U.S. equities. That is the 19th principle. When money flows into broad indexes, the largest index constituents often receive the largest dollar flows. This can support mega cap companies. It can also create concentration risk. If retirement flows increasingly buy the same broad indexes, the market may become more dependent on the largest companies that can work during bull markets, but it can also increase vulnerability if those companies become overvalued. So the opportunity is not risk. Free broad market exposure may benefit from flows, but valuation still matters. The 20th principle: flow can push prices up, but valuation determines long-term return. If too much money chases the same assets, future returns can fall even if near-term prices rise. This is why investors must think in time horizons. Short-term flows may support prices. Long-term earnings, valuation, productivity, and inflation. Adjusted returns matter. Now let us talk about volatility. The source argues that more free money and more access may create bigger swings. That makes sense. When more retail investors enter markets, and when policy injects more liquidity, markets can move more dramatically. People become excited during rising periods and fearful during falling periods. More participants can mean more momentum in both directions. This creates opportunity for disciplined investors. Crashes create lower entry prices, but only if you have cash. Courage and a plan. A market crash does not create wealth automatically. It creates opportunity for people who are prepared. That is the 21st principle. Volatility is opportunity only for investors with liquidity and discipline for everyone else. Volatility is panic. If Trump IRA flows push markets higher over time, investors benefit if those flows also create more volatility, then downturns may become more severe or more emotional. The smart investor prepares for both. Own where money is moving, but keep cash for crashes. Do not confuse upward flow with permanent safety. Markets will still fall. Recessions will still happen. Bad companies will still exist. Valuations will still matter. Risk will not disappear. Now, let us talk about the phrase, own where the money is moving. This is an important investor idea. Money movement creates price movement. If pension funds, retirement accounts, 401ks, IRAs, and now possibly Trump IRAs are structurally allocating to U.S. equities, then U.S. equities receive long-term support. That does not mean every year is positive. It means there is a persistent demand channel. If the government subsidizes that channel, the flow becomes stronger. That is why financially savvy investors study policy. Policy changes flows. Flows change markets. Markets change wealth. That is the 22nd principle. The investor who understands policy-driven flows can see opportunities before they appear in earnings reports. This does not require conspiracy thinking. It requires watching incentives. If the government gives people money that must be invested into retirement accounts, that money becomes demand for financial assets. That is straightforward. Now, let us think about the average worker. For a worker without a retirement plan, the Trump IRA could be a good step if the fees are low, access is easy, and the match is real. But the worker must still understand investment risk. Stocks go down. Index funds lose money during bear markets. Retirement accounts have rules. Taxes matter. Withdrawals may have penalties. Inflation may change real returns. Financial access without education can be dangerous. A person given access to markets but no understanding may panic during the first decline. That is the 23rd principle. Access must be paired with education, or the system may create investors who buy high and sell low. This is one of the great weaknesses of democratized finance. Access alone is not enough. People need to understand fees, compounding, diversification, volatility, taxes, time horizon, and risk. Otherwise, a retirement account becomes another place where fear and excitement create bad behavior. Now let us compare 401k IRA and the Trump IRA conceptually. The 401k is employer-based. It can include a match. It can have high contribution limits. It can have either traditional or Roth tax treatment. It can be powerful, but access depends on the employer and fees vary. A traditional IRA or Roth IRA is individual-based. It is portable. It can be opened outside an employer. It has lower contribution limits than a 401k. It may not have a match. The Trump IRA, as described in the source, appears to combine individual portability with government matching for qualifying lower-income workers and low fees. It is designed to bring 401k-like advantages to people outside the 401k system. That is the structure. The question is whether it will work as designed and how large it becomes. That is the 24th principle. Account design matters, because it determines who can access compounding and how much friction they face. Low friction can change behavior. Automatic enrollment, easy contributions, low minimums, clear funds, low fees, and matching all increased participation. If participation increases, asset ownership broadens. That could be good for households. It could also increase dependence on market performance. Again, both sides matter. Now let us discuss the political dimension without becoming partisan. A policy can be good for some workers and still inflationary. A policy can increase retirement access and still increase government debt. A policy can support the stock market and still worsen inequality between asset owners and non-owners. A policy can be popular today and costly later. The serious investor should not begin with party loyalty. The serious investor begins with cause and effect. What does the policy do? Who receives money? Where does the money go? How is it funded? What asset class benefits? What macro risk increases? What behavior changes? That is the 25th principle in investing. Political opinions are less useful than incentive maps. A person can like or dislike Trump and still need to understand the account. A person can support or oppose the policy and still need to understand the flow. Markets do not care about your emotional reaction. They care about money movement, policy, liquidity, earnings, and expectations. Now let us talk about the phrase, the most expensive money is free money. That sounds contradictory, but it is often true. Free money changes behavior. If people believe money is free, they may stop asking what it costs. Governments may distribute more. Voters may demand more. Markets may price in more support. Asset prices may rise. Debt may increase. Inflation may follow. The free money is free to the recipient today, but not free to the system. The bill may appear later. It may appear as taxes. It may appear as lower purchasing power. It may appear as higher interest expense. It may appear as asset bubbles. It may appear as volatility. That is the 26th principle. Free money is often paid for by people who do not see the invoice. This is why the government match should be viewed with both appreciation and skepticism. If you qualify, taking the match may be rational. Refusing it may not change the national debt, but as a citizen and investor, you must understand that the match is funded by a larger fiscal system already under strain. Use the benefit if it fits your life, but do not misunderstand the macro cost. Now let us think about inflation's effect on workers. If the government prints or borrows more and inflation rises, workers relying on wages and cash savings are hurt. Their salaries may not keep up. Their bank savings lose purchasing power. Their expenses rise. Meanwhile, asset owners may see stocks, real estate, gold, or other assets rise in nominal terms. This widens the gap between owners and non-owners. Ironically, the Trump IRA may be an attempt to bring more people into ownership so they are not left behind. That is the positive case. If inflation is the environment, then helping low-income workers own assets may be better than leaving them with only cash wages. But again, if the program itself adds to inflation, the system is circular. That is the 27th principle. In an inflationary system, the best protection for workers is ownership. But the policy that creates ownership can also contribute to inflation. This is the contradiction. It is not easy. The answer is not simply to reject ownership because the system is flawed. The answer is to understand the system and use it intelligently. If asset prices are likely to benefit from flows and inflation, then owning productive assets becomes more important. Now, let us talk about practical investor behavior. If you have access to a 401k with a strong employer match, capture the match. That is often the first priority. If your 401k fees are high, choose the lowest, cost-sensible funds available. If your plan is poor, consider what other accounts you can use. If the Trump IRA becomes available and you qualify for the match, compare it to your existing options. Look at the expense ratios, look at the tax treatment, look at the match, look at the investment choices, look at your income eligibility, look at withdrawal rules, look at contribution limits. Do not rely on slogans. That is the 28th principle. The best retirement account is the one that gives you the highest after fee after tax. Behaviorally sustainable compounding for your situation. This is a mouthful, but it is true. A low fee matters, a match matters, tax treatment matters, investment choices matter, behavior matters. Do not choose based only on the account name. Now let us examine the market opportunity more closely. If $32 to $68 billion enters the stock market, where might it go? Retirement systems typically prefer diversified funds. Many people may choose total market funds, SP 500 funds, target date funds, or default portfolios. If the account is designed to be simple and low fee, broad index funds may dominate. That supports passive investing flows. Passive flows tend to buy according to market capitalization. This means the largest companies receive more dollars because they are the largest weights. Over time, this can reinforce concentration in the largest companies. That is the 29th principle. Passive flows can strengthen the companies that are already large. This has been one of the defining features of modern markets. It does not mean large companies are bad investments. Many are excellent businesses. But it means investors should understand concentration risk. If everyone buys the same index, the index may become more expensive. If the largest companies stumble, the whole index can feel it. So broad funds are simple but not riskless. Now let us talk about target date funds. If the Trump IRA uses simplified retirement menus, target date funds may be common. These funds automatically adjust the mix of stocks and bonds as the investor approaches retirement. They are useful for people who do not want to manage allocation. But target date funds have fees, glide paths, and assumptions. Some are aggressive, some are conservative, some have higher fees than necessary. Again, the investor must look under the hood, the 30th principle. Default choices are powerful because most people do not change them. If the default is good, millions benefit. If the default is expensive or poorly designed, millions suffer quietly. This is why the account S design matters as much as the account S existence. Low fees, good defaults, simple options, and clear education can determine whether the program succeeds for workers. Now, let us think about the broader economy. If more money goes into stocks, households may feel wealthier as account balances rise. That can support consumer confidence. Companies may benefit from higher valuations. The wealth effect can increase spending. But if the money comes through more debt and money creation, inflationary pressure may offset some benefits. In the long run, true wealth comes from productivity, new businesses, better technology, more efficient production, higher skills, stronger earnings, real output. If retirement account flows raise asset prices without increasing productivity, the gains may be partly financial inflation rather than real wealth creation. That is the 31st principle. Asset price increases are not the same as real wealth unless they are supported by real productivity and earnings. This is why money printing cannot create wealth by itself. It can reprice assets, it can shift purchasing power, it can support liquidity. But real wealth requires real goods, services, innovation, and productive capacity. Investors must separate nominal gains from real gains. If your portfolio rises 10%, but the currency loses purchasing power, your real gain is smaller. Now let us discuss the generational effect. Older workers may have less time to benefit from compounding. Younger workers may benefit much more. If the Trump IRA encourages young low-income workers to start investing early, the long-term impact could be meaningful. A small annual match invested for decades can compound dramatically. The greatest advantage is time. This is why access at a young age matters. A 25-year-old receiving even small government matches and contributing regularly could build meaningful retirement capital by 65. A 55-year-old has less runway. That does not mean it is useless. It means the policy may be most powerful for younger workers who begin early and stay consistent. That is the 32nd principle. The earlier a worker enters the ownership system, the more valuable each match dollar becomes. This is why small contributions matter. A $1,000 match at age 25 can compound for 40 years. A $1,000 match at age 60 has far less time. Time multiplies the benefit. Now let us think about the requirement to contribute. The government match is not simply a gift with no worker action. The worker must contribute to receive it. That creates a savings incentive in behavioral finance. Matching can nudge people to save more because they do not want to leave money on the table. This can be very good, but it also requires cash flow discipline. The worker must spend less than they earn or increase income enough to contribute. That is the 33rd principle. A retirement match rewards surplus. If a household has no surplus, the first financial problem is cash flow. This means policy access must be paired with income growth, budgeting, debt reduction, and financial education. Otherwise, the people most in need may not capture the full benefit. Now let us talk about the political promise of replacing the 401k. The source says the Trump IRA could almost reset how Americans think about retirement. That may be true if the program becomes large and widely used. But I would be careful with the word replace. The 401k system is enormous, entrenched, and still valuable for many workers. A new IRA may supplement the system more than replace it, but the psychological shift is important. Retirement may become less employer-based and more worker-based. That could be a major evolution. The 34th principle, the future of retirement may be less about where you work and more about whether you own a portable investment account. This fits the modern labor market. People change jobs, people have side gigs, people work independently, people move. A portable account makes sense. But again, a portable account does not remove market risk or fiscal cost. Now let us talk about the danger of political branding and financial products. Calling it a Trump IRA may create strong emotions. Some people may like it because of Trump, others may dislike it because of Trump. Both reactions can cloud judgment. The account should be evaluated by its mechanics, fees, match eligibility, portability, investment options, tax treatment, funding, macro impact. Do not let branding prevent analysis. That is the 35th principle. A financial product with a political name still needs a financial evaluation. Investors must train themselves to think independently. Politics can be emotional. Markets require cause and effect thinking. Now, let us revisit the debt issue. The United States already has large debt and deficits. Adding another program may seem small relative to the federal budget, 32 to 60. $8 billion is not enormous compared with trillions of spending. But the issue is not only one program, it is the pattern. Every program says it is manageable. Every program has a justification. Every program has beneficiaries. The cumulative result is debt. That is the 36th principle. A debt crisis is built one reasonable sounding promise at a time. This is why fiscal discipline is hard in democracies. Each benefit has supporters. Each cost is spread widely. Borrowing delays the pain. Money creation hides it further. Inflation reveals it later. Now, let us think about how investors can respond to this broader pattern. If governments are likely to run deficits and support asset markets, then owning assets becomes more important. Broad stocks may benefit, real assets may benefit. Businesses with pricing power may benefit, hard assets may benefit. Cash may lose purchasing power over time, but if asset prices become overextended, future returns can disappoint. So the answer is not reckless buying at any price. The answer is disciplined ownership. Dollar cost averaging, diversification, low fees, cash reserves, buying during downturns, avoiding panic, taking advantage of matches. That is the 37th principle in a debt-driven system. Asset ownership is necessary, but price discipline still matters. Do not become a blind buyer because the government is adding flows. Flows support markets, but valuations and cycles still exist. Now let us discuss crashes. The source emphasizes that market crashes will continue. That is important. More retirement inflows do not eliminate recessions. In fact, liquidity and policy-driven flows can sometimes inflate asset prices, making future corrections sharper. The smart investor should not fear crashes only. The smart investor should prepare for them. If markets fall, retirement contributions continue buying lower prices. If you have cash, you can buy more. If you have a long horizon, downturns can increase future returns, but only if you do not sell in panic. That is the 38th principle. Crashes create wealth for investors who have a plan before the crash arrives. The Trump IRA may bring more people into the market, but new investors must understand that losses are part of investing. If they enter during a rising market and panic during the first decline, the program may fail them behaviorally, even if it works structurally. Education matters again. Now, let us think about what low-income workers should do if this account becomes available. First, check eligibility. Second, understand the match. Third, calculate whether you can contribute enough to receive the full or partial match without harming essential cash flow. Fourth, use low-cost diversified options. Fifth, do not withdraw early unless truly necessary. Sixth, treat the account as long-term retirement money. Seventh, increase contributions as income rises. Eighth, avoid high-fee options if low fee options exist. Ninth, keep emergency savings outside the retirement account. 10th, do not panic during market declines. That is the practical system, the 39th principle. The match is valuable only if the account survives long enough to compound. If a worker contributes, receives the match, then withdraws early during hardship or panic, the long-term benefit may be damaged. This is why emergency savings still matter. Retirement accounts should not be the only financial cushion. Now, let us think about high-income workers who do not qualify. They may not receive the government match, but they can still learn from the policy. The direction of policy suggests more money may flow into U.S. equities. That can affect markets. High-income workers should review their own 401k fees, maximize employer matches, consider IRAs where allowed, use taxable brokerage accounts, and understand asset allocation. The Trump IRA may not benefit them directly, but the market flow may affect their portfolio. That is the 40th principle. A policy can affect you even if you are not eligible for its direct benefits. If new money enters the stock market, all asset owners may feel the effect. If inflation rises, all currency users may feel the effect. Now, let us talk about the phrase, win in the economic system. That phrase can sound harsh, but the reality is that people who understand the system usually do better than people who only complain about it. If the system rewards asset owners, become an asset owner if you can. If the system penalizes cash through inflation, do not keep all long-term wealth in cash. If the system sends money into broad markets, understand the flows. If the system uses debt and money creation, own things that can preserve purchasing power. This does not mean the system is fair. It means you must understand it. That is the 41st principle. You do not need to approve of a system to position yourself intelligently inside it. A person can criticize inflationary policy and still own assets. A person can worry about deficits and still capture a match. A person can dislike political branding and still analyze the account. Understanding comes before judgment. Now let us consider possible risks or uncertainties. The program may change before launch. Eligibility rules may change. Funding may be debated. Investment options may be limited. Fees may be capped. But hidden costs or limited menus may appear. Administrative complexity may reduce participation. The government match may be smaller than expected. Markets may fall after new investors enter. Inflation may rise. Political changes may modify the account. These are all real uncertainties. That is the 42nd principle. A new policy is not a finished machine until the rules are implemented and tested. Investors should follow the details as they develop. Do not assume every early claim will survive unchanged. But do not ignore the direction either. The direction is broader access to stock market ownership and more government-linked retirement flows that matters. Now, let us bring the whole cause and effect chain together. The 401k system excludes millions of workers because access depends on employers. Some 401k plans have high fees that reduce long-term wealth. 401ks can be difficult to move between jobs. The Trump IRA is proposed as a portable, low-fee, low-minimum account for workers. Qualifying lower-income workers may receive up to $1,000 per year in government matching funds if they contribute enough. This could bring tens of billions of dollars into the stock market starting in 2027. More buyers can support stock prices, but government matching requires funding. If taxes are not raised, the government likely borrows more. More borrowing can increase dependence on debt markets and possibly money creation. Money creation can contribute to inflation. Inflation hurts wage earners and cash savers while asset owners may benefit. Therefore, the account may help workers become owners while also reflecting the deeper debt and inflation dynamic of the system. That is the full structure. The 43rd principle, the same policy can be a benefit at the household level and a risk at the macro level. This is why thinking must be layered: individual level, capture low fees and matching if eligible; market level, recognize new equity flows; macro level, watch debt, money creation and inflation; behavior level, prepare for volatility and avoid panic. Now, let us talk about what I would do conceptually if I qualified for a match. I would take it seriously. A 50% match is difficult to beat. I would still make sure I had emergency cash and no destructive high-interest debt. I would choose low-cost diversified investments. I would not treat the account as short-term money. I would automate contributions if possible. If I did not qualify, I would still review my own retirement fees. Many people are unknowingly paying too much. I would check every expense ratio. I would compare available funds. I would make sure I am receiving any employer match. I would consider broad market exposure if it fits my plan. I would remember that more policy-driven market flows may support stocks but not remove risk. That is the 44th principle. Do not let a new account distract you from the basic retirement rules. Capture match. Minimize unnecessary fees. Diversify. Invest consistently. Keep costs low. Understand taxes. Avoid early withdrawals. Stay invested through cycles. Those rules still matter. Now let us think about fees one final time. The difference between 1.26% and 0.15% looks small on paper. But the Source S example shows how it can mean roughly $120,000 more after 30 years under the same gross returns. That money can represent years of retirement spending, healthcare costs, housing support, or inheritance. Small annual leaks become large lifetime losses. That is why financial literacy must include fees. The 45th principle: if you do not understand expense ratios, you may be working for the money manager without realizing it. This does not mean all money managers are bad. It means every investor must ask whether the fee is worth it. The lower the expected return environment, the more fees matter. If returns are modest, high fees can eat a large share of the result. Now, let us talk about inflation again, because this is the other hidden fee. Inflation is not called an expense ratio, but it acts like one on cash. If your savings earn less than inflation, your purchasing power is being reduced. If the government funds programs through debt and money creation, inflation risk can rise. That is why retirement planning cannot be only about account balances. It must be about real purchasing power. A portfolio that grows nominally but fails to outpace inflation may not provide security. That is the 46th principle. Retirement is funded by real purchasing power, not nominal account numbers. This is why assets matter. Broad equities can potentially grow with corporate earnings and inflation over time. Real assets can help, productive ownership can help. But nothing is guaranteed. The plan must be diversified and disciplined. Now let us think about people who distrust the stock market. Some distrust is understandable. Markets fall. Wall Street profits from fees. Financial products can be confusing, but avoiding the market entirely may leave a person dependent only on wages and cash, both of which can be damaged by inflation. The better response is not blind trust. It is informed participation. Use low-cost funds, avoid speculation, understand risk, invest for decades. Do not let Wall Street complexity keep you from basic ownership. That is the 47th principle. You do not have to trust every financial institution to understand the value of owning productive assets. A broad index fund is not perfect, but it may offer a simple way to own pieces of thousands of companies that is different from gambling on one hot stock. Now, let us discuss how this affects inequality. If the Trump IRA succeeds in bringing more lower-income workers into asset ownership, it may reduce one barrier to wealth building. But if low-income workers cannot contribute enough, or if inflation rises faster than their wages, the benefit may be limited. If asset prices rise and existing investors benefit most, inequality may still widen. That is the complexity. A policy can improve access and still fail to fully solve inequality. The 48th principle: access is necessary but not sufficient. People also need income, surplus, education, low fees, stable rules, and time. Without surplus, access is unused. Without education, access may become speculation. Without time, compounding is limited. Without low fees, returns leak away. Now, let us think about the stock market in 2027. If the program begins, then investors may anticipate flows before the money actually arrives. Markets often price expected flows early. If investors believe tens of billions will enter equities, some of that expectation may appear in prices before implementation. If the rollout disappoints, there could be reversal. That is the 49th principle. Markets price expectations before cash fully moves. This means the opportunity may not wait until the official start date, but it also means risk exists if expectations become too optimistic. Again, do not chase without a plan. Now let us talk about the difference between ownership and speculation. If a worker contributes to a Trump IRA into a diversified low-cost fund for 30 years, that is ownership. If a person sees headlines and buys risky stocks because they think government money will pump everything, that is speculation. These are not the same. The policy may create opportunity, but the investor must choose the right behavior. That is the 50th principle. A good macro trend can still be ruined by bad execution. The existence of more stock market flows does not justify reckless behavior. It supports disciplined, long-term investing. Now, let us connect this to the broader debt cycle. Ray Dalio often emphasizes that debt cycles matter. When a country borrows more than it earns, it must eventually manage the imbalance through some combination of higher taxes, lower spending, default restructuring, inflation, or money creation. In a fiat system, inflation and money creation often become politically easier than direct default. The Trump IRA in this context is not only a retirement policy, it is part of the broader pattern of using government balance sheets to support households and asset markets that can work for a while, but the long-term consequences depend on productivity, fiscal discipline, interest rates, and trust in the currency. That is the 51st principle. A country can use debt to distribute benefits, but it cannot use debt forever without consequences. The consequences may be delayed, they may be softened, they may be hidden, but they do not vanish. Now, let us think about what this means for the average saver. If you keep most of your wealth in cash because you fear markets, inflation may silently tax you. If you invest in high-fee funds, Wall Street may quietly tax you. If you ignore matches, you leave valuable money unused. If you enter markets without education, volatility may punish you. The correct response is balanced. Hold emergency cash, invest long-term money, keep fees low, use matches, diversify. Learn, do not panic. That is the 52nd principle. The system punishes both ignorance and overconfidence. Ignorance leaves money idle or in high fees. Overconfidence creates speculation. The middle path is disciplined ownership. Now, let us prepare the conclusion. The Trump IRA may become a powerful tool for workers without 401k access. It may reduce fees, it may improve portability, it may allow very small contributions, it may give matching money to lower income workers, it may bring billions into the stock market, it may support asset prices, it may also require more government borrowing, it may contribute to inflation. It may make the market more politically important, it may create volatility, it may benefit asset owners more than cash savers. All of these can be true at the same time. That is the final principle. A serious investor must be able to hold two truths at once. A policy can help individuals and still create macro costs. A stock market flow can create opportunity and still increase risk. A government match can be valuable and still not be free. A low-fee account can be good and still not replace every retirement option. Now, what should you do if you are eligible when the account begins? Study the rules, do not ignore a match, but do not invest money you need for survival. Build cash reserves, understand the funds. Keep fees low. Think long-term. If you already have a 401k, check your fees, make sure you receive the match. Compare investment options, do not assume your plan is good just because it exists. If you are an investor, watch where policy is sending money. Broad U.S. equities may receive support from new flows, especially total market and SP 500 funds. But do not forget valuation and volatility if you are a citizen. Understand the funding. Government money comes from taxes, debt, or money creation. If debt and money creation rise, inflation risk rises. Protect yourself by owning productive assets, not only paper cash. This is how to think about it, not emotionally. Systematically, the Trump IRA may be sold as retirement help, but underneath it is a much bigger story about who gets access to ownership, how government supports markets, how fees quietly drain wealth, how debt funds promises, and how inflation transfers purchasing power from savers to asset owners. If you understand that, You can use the system instead of being used by it, and that is the point. The economy is not fair to people who do not understand how money moves. Money moves toward assets, policy moves money, fees divert money, inflation weakens money, compounding multiplies money. The worker who understands those forces can make different choices. The worker who does not may keep earning, keep saving, and still fall behind. That is why this matters. The Trump IRA is not just another account. It is a window into the next stage of the American retirement system. More access, more stock market flows, more government involvement, more debt pressure, more inflation risk, more opportunity for people who understand the machine, and more danger for people who mistake free money for costless money. The account may begin in 2027, but the lesson begins now. Check your fees, understand your retirement accounts. Own where long-term money is moving, respect inflation. Prepare for volatility, use matches if you can. Keep your costs low, and remember this, the government can print dollars, it cannot print wealth. Wealth comes from ownership, productivity, discipline, and time. If the system is going to push more dollars into assets, then the question for you is simple. Will you remain only a wage earner and cash saver, or will you become an owner in the system your own government is trying to feed? That is the real decision.